Hey there, welcome. If you've ever looked at the stock market and thought it's some kind of complex, confusing game that's only for the experts, well, this one's for you. We're about to break down the wisdom of the legendary investor Pat Dorsey into a super clear, actionable guide that's going to completely change how you think about building wealth. I mean, that's the big question, isn't it? It's probably why you're here. You want to build a financial future that's secure, not just for tomorrow, but, for the long haul. And yeah, investing is the key for sure. But the sheer amount of noise, all the different companies, the constant chatter from the market, it can feel totally paralyzing. It's so easy to just throw your hands up and ask, where do I even start? Well, you start right here. So here's our game plan for today. Think of it as your roadmap, your quest map to becoming a much smarter, more confident investor. We're going to cover the essential rules, the big traps you've got to sidestep, the tools you'll need, and the mindset that really ties it all together. Okay, let's kick things off with the absolute foundation for successful investing. Don't think of these as just tips. Think of them as the essential rules that every single smart investor lives and breathes by. All right, rule number one is a classic for a reason. Do your homework. You have to truly understand a business before you even think about putting a dime into it. Second, you've got to find what's called an economic moat, that special thing that protects a company from its rivals. Third, and this is crucial, always insist on a margin of safety. A great company is only a great investment if you don't overpay for it. Fourth, you have to play the long game. Real wealth is not a get-rich-quick thing. And finally, number 5, know when to sell. And that decision, it should be based on the business, not just a random dip in the market. Let's just pause on this one for a second, because it is a huge concept. An economic moat, it's exactly what it sounds like. It protects a great company's profits from all the competitors trying to storm the castle. It could be a super powerful brand, a massive cost advantage, or some unique technology. Seriously, finding businesses with wide, deep moats is right at the heart of smart investing. This quote just nails that third rule, doesn't it? A perfect example of this is Coca-Cola way back in the early 90s. Everybody knew it was an incredible business with a massive, massive moat. But the hype drove the price up so high that a lot of investors who bought in then actually saw pretty lousy returns for years. It just proves that a great business is only a great investment if you buy it at the right price. And that gap between the price you pay and what it's really worth, that's your margin of safety. All right, so we've got the rules down. Now let's look at the other side of the coin. Knowing what to do is half the battle, but you also have to recognize the dangers out there. So let's talk about the common traps that can just quietly eat away at your returns if you're not paying attention. Come on, we've all been tempted, right? Chasing that hot stock everyone is talking about, thinking, the old rules don't apply anymore. Or getting so attached to a product you love that you totally ignore the company's financials. Or maybe the worst one, panicking and selling everything when the market takes a dive. Avoiding these gut reactions is honestly just as important as following the rules we just talked about. And this right here, this highlights a mistake that is at the core of so many investing blunders, confusing price with value. Price is just what you pay, and it's so often driven by emotion and hype. Value, on the other hand, is what the business is actually worth. The whole goal of a smart investor is to never, ever get those two mixed up. So how do you figure out that real value? Well, you need the right tools. And this isn't about some crazy complex algorithm. It's just about learning the language of business. That way you can look at any company and analyze it with real confidence. Look, to be a successful investor, it really comes down to understanding 3 key documents. You've got the balance sheet, which is basically a snapshot of what a company owns and what it owes. Then there's the income statement, which tells you if it's making a profit or a loss. And finally, the cash flow statement, which tracks the actual real cash moving through the business. These 3 together, they give you the complete picture. Okay, this is such a critical point for any investor to really get. Reported earnings can look amazing on paper, but accounting rules can sometimes allow them to be, let's say, tweaked. Cash flow, though? Cash flow doesn't lie. It's the real money moving in and out of a company. It is its true lifeblood. A genuinely healthy business will almost always have strong, positive cash flow. All right, enough theory. Let's apply this toolkit to a real company. Let's take a look at AMD back in the early 2000s, and we can see exactly how these principles play out in the real world. $1.9 billion. That was the amount of debt sitting on AMD's books at the end of 2002. Now, for a huge, stable company, maybe that's manageable. But for a company the size of AMD back then in a crazy competitive industry like semiconductors, a number like that isn't just a question mark. It is a giant, flashing red flag. That's a massive financial weight to be carrying. So, when you actually put all the pieces from the financial statements together, the picture for AMD at the time becomes, well, pretty alarming. The company was consistently burning through cash, it was drowning in that $1.9 billion of debt, growth was just kind of sluggish, and all the while, the executives were getting paid really, really well. See? The toolkit doesn't lie. The analysis showed this was a super risky investment back then. And all of this brings us to the most important mindset shift you can make. Once you're armed with this knowledge, you're not a speculator anymore. You're not just hoping for a lucky break. You are an investor, and you are making informed decisions. And that right there is the ultimate takeaway. Without doing your homework, you're just rolling the dice in a casino. Real, lasting wealth is built by understanding businesses, buying them at a fair price, and focusing on managing your risk. You do that, and the returns will take care of themselves. So there you have it. You've got the rules, you've got the warnings, and you've got the tools. The path to building real wealth isn't some big secret, it's a discipline. So the only question left is, are you ready to start your journey with clarity and with confidence?